Hello everyone, welcome back to the channel. Daniel McGuire here, and in today's video I'm going to be talking about investing or financial strategies that you could kind of do in your early 20s if you have a part-time or full-time job to save up a little bit of money to maybe reach a certain goal that you want to have in your savings account, or save up towards something that you're really looking forward to, maybe like a car or something, in along that manner that you could save up for. And be sure you like the video, subscribe to the channel, and let's get to it. So one place that you could be starting out your savings account would obviously be, a savings account, with a bank. And the benefit of that is, it's very secure. You're not really going to lose any money, but you're also not going to be really gaining any money. You're only maybe going to be gaining 0.01%, which isn't really anything. Another potential future or way that you could invest your money would be like in the stock market. Low funds in the stock market could prove to be very beneficial depending on which stocks you do invest in. And you have that option. You could invest in, individual stocks, which are, like your Teslas, your Apples, your Facebooks, those big companies that have their individual stock. You can buy into those specific stocks, which could prove to be very advantageous if they do take off and they do become very big. Like obviously, Amazon, one of the biggest stocks in the world right now, a few years ago was trading for a few $100s. Now it's a few thousand. So something like that, you could easily start getting your foot in the door and start really playing out the stock market. It's obviously very tricky to predict whether a stock is going to be successful or not. So therein lies the trouble of, pursuing that and really going forth with individual stocks. Another one is going to be like, shared funds, where you have, the S&P 500 compiled into a stock where it essentially tracks all of the top 500 stocks in the stock market, and then it's eventually a big mutual fund where you invest your money in that and it's kind of tracking it. So it's really a lot safer, but it's more costly to really invest in that, and it's usually about, on average, about a few percent a year gain on what you're going to be investing. So that's another route that you could choose to invest in. And then obviously, apart from the traditional savings accounts from the banks or the stock market, you could also go with a high saving yield, which is a bank account, which is like, like an Ally Bank or another type of online banking service, where they offer you about 1.5 to 2% on your savings annually, which is pretty good considering the fact that tries keeping up with inflation. Inflation currently is around 2% on year average. So you really want to consider, where your money is going to be able to grow without remaining stagnant due to inflation, reducing the value of your money being saved. Now, another completely different form of investing versus the traditional, savings accounts, high yield savings accounts or stock market, is the more, millennial, traditional, new sense of savings and investing is kind of like, high-end marketing brand stuff, like Nike, where they have a collab with a certain creator or a certain design brand. That is a new market that I think is very beneficial for people to invest in potentially. If you can, get a shirt for $20 and then hold on to it for a few months or a year, then that could inherently increase in value maybe to $100 to $200, and you would have gained 5 times or maybe even 10 times your initial investment. I know Supreme is like a huge thing, right now, where like you invest $30-40 and then a certain item could go up to maybe $200, $300 in the course of less than a year. Same thing with like Nike or any type of Air Jordan 1s, a lot of shoes, a lot of different things that you can invest in to really increase your portfolio value. In my opinion, if you have your stocks diversified, that's a great thing. But the more investments and the more money that you have allocated in different locations, the better off you'll be, because you're going to have that freedom to kind of go all over the place. You won't be necessarily locked into just, I'm only going to invest in the stock market, and if that doesn't go for me, then I'm just going to keep throwing my money away. And vice versa. If you're like, let's say you're chasing all of Supreme drops or all of the newest shoes drops, and like you just, I'm only going to do that, then yeah, you can obviously be successful just like you could be successful in the stock market, but it's going to be a lot more challenging where, if you're having like, let's say an off month or an off few weeks with investing with that and buying certain things at retail value and then reselling them, then you're going to not have any money with which to invest and save forth with that. So it's kind of good to have a little bit of everything. That's what I've been doing. I've been like definitely reading up on a lot of things to invest in. So I've definitely have a little bit of money invested in stocks. I have a few like collector's items, I guess you would say, to have a little bit more fluidity and have a completely diversified portfolio. And certain things that wouldn't even think have any value, like especially extreme value, like Supreme or like any type of Air Jordan Nike collabs, are definitely very key for the future, I'd say. And I'd say that's a very good stepping stone for a lot of young investors in their early 20s. Maybe you really like shoes and you want to buy this particular pair of shoes, and then you have them and you see the value growing on them, that's a type of stock that you're investing in, and that's a way that you can really start growing your idea of what to invest money in. And if that's the route for you to begin, then that's a great route to begin with, because you are going to see, you know, all your money start growing and compiling and compounding with, you know, your initial investment of maybe like $100 for shoes, and that keeps on growing. That's the same thing with a stock. It's going to keep on growing potentially. So you have that variety, and I'd say a good transition zone to begin investing in your early 20s if you don't really have, you know, a lot of money for a huge index fund or a huge individual stock. So you always hear the age-old saying, you know, I wish I would have started investing earlier. So you really can do that, and it just sets you up later down in life to where you have money saved up, let's say for a rainy day or something you really want to buy, but at that point in time don't have the excess amount of funds to really afford it. It really does help you begin a certain chapter in your life if you start early, when you really don't have, you know, a lot of funds, but you are saving a portion of it. It just teaches your mind to really just be a little bit frugal and save money where you really can do it, versus when you're older and let's say you've always kind of just spent your whole money as an individual. When you're younger, then you're obviously going to try doing the same thing maybe when you're older. So it just kind of gets you out of that habit, so you can kind of start transitioning to begin that idea of saving now, and you could move it towards in the future, and you could have a little bit of money saved up, and you could really see the dividends when, like, let's say you set a goal for yourself of maybe like, I want to save $1,000 by the end of the year, and you reach that goal, then you're going to be like, wow, I have the money, I could do it. Like, let's up the ante and let's try saving a little more if we can. That's definitely one of the benefits. And you know, any amount of money that you have saved up is a great thing. Money now is a great thing, money down the road, because of the way that you'd be able to potentially invest it. So definitely consider, you know, the earlier you start, the better off you'll be, because by the time, let's say you're in your mid to late 20s and you really wanted to, let's say, buy a car, then you would have to maybe work up for it if you don't have any money for down payment. But let's say you started in your early 20s investing and you have money saved up from that time to buy a car, then that's definitely going to benefit you, because you're going to have that money already saved up and allocated for a potentially rainy day, or in this case, you know, something that you really wanted to buy. So that's really going to help you later down the line in life, where you are going to have that idea of saving, and you're really just going to build up your money potentially from that to begin a very diversified portfolio. And lastly, just definitely wanted to touch up on the thing, you know, any type of savings is a great savings. It just sets you that mentality, as I mentioned earlier. You know, it doesn't necessarily have to be, you know, the traditional route of stocks. It could be, like I mentioned, you know, shoes or any type of other thing that you really view as valuable, and then you could just invest money in. Obviously, you know, like very simplified ideas that you can invest your money in. There are hundreds of others ways you can do it. You know, just definitely consider starting young, investing your money as promptly as you can, and just have an idea of what you really want. You know, maybe you want to set a goal for yourself, like 10 years down the line, I want to have this amount of money. And you could really, again, just, it's all about saving. It's all about producing the most money for the amount of time that you're going to be putting into it. You know, right now, not a lot of people in the US have, you know, $1,000 to their name, due to the fact that not only is it, you know, you have the high cost of a lot of things, you have a lot of people having to pay for healthcare, you have a lot of people having to diversify a lot of things, but also comes down to financial freedom. You know, they don't really have that idea of saving. You know, a lot of people, especially in my family, where, you know, they have money, and then the second they have it, boom, they want to spend it all, because, you know, they have this fear of having it in an account. They have this fear of, you know, maybe the market crashes or something and they just won't have any more money. So they would prefer to spend it than save it. And, you know, in my opinion, I would say the more you have saved up, the more you could save up for a rainy day, the more you can have, you know, prepared for something you may not foresee, and you just be prepared for any curveball that you might be thrown in life. All right, so that's it for today's video. Make sure you have any questions, you can make sure to leave them in the comment section below. As I mentioned earlier in a prior video, I'm definitely going to start transitioning to kind of giving a little bit more financial advice and kind of, you know, entry-level advice now that I've graduated from college. I'm definitely going to try and diversify my audience and diversify, you know, the information I'm giving out to try and benefit as many people as possible in that early college, kind of just graduated or age, you know, where you are still kind of in limbo as to, you know, you just graduated college, you have a potential job or internship, and you don't really know what to do with it or kind of like what to expect out of it. So yeah, be sure to like the video, subscribe to the channel, and thank you for watching.